Hello and welcome to The Upside. I'm Pamela Ritchie. Last March, of course, the stock market was upended by COVID-19. Financial advisors have added incredible value in the lives of so many investors since then by coaching them through uncertain times, staying disciplined, and by investing through to the other side. In partnership with advisors, Fidelity Portfolio Manager Dan Kelley, manager of the Founders Fund, has also added value by outperforming the stock market throughout the recovery, and really the recovery that we see continuing here today. In fact, the fund that Dan manages on behalf of many of you here has returned 22.6% on an annualized basis. And we're very pleased to say that Dan joins us here and now today. Dan, great to see you. Welcome.
Great to see you, Pamela. Thanks for having me.
So glad that you could join us here today. I really would like us to begin with a little bit of a tour through the Founders Fund and to see how it came about, actually, because of course things don't sort of happen overnight. Give us the beginnings, the sort of early evolutions of how the Founders Fund came to be.
Well, thank you, Pamela, for asking the question, because although the fund just hit its 3-year track record in April, this is an idea that we've been working on for over 5 years. We started researching this idea after Will Danoff, who I know many of the unit holders on the call have heard of, and Joel Tillinghast, both kind of observed through their multi-decades of investing that founder-led companies tended to be highly correlated with outperformance. So what we did in conjunction with our quantitative research team, we did extensive research and we found that to be the case. We found about 300 basis points of annual alpha if you invested in what we define as founder-led companies. And that led us to do more work. And so we started a pilot internally. And you're probably asking, well, why is Dan Kelley running the fund? Well, my background as an analyst at Fidelity, I covered a lot of sectors where there was a high proportion of founder-led companies. And so I had a real belief, even before we did the extensive research, that this was the case, that founders have a lot of value to add. They treat all stakeholders as owners. They're visionaries. They bring a lot to the table, Pamela. And I think over time, we've been able to stock pick within the founders universe to hopefully demonstrate that to our investors.
I mean, it is fascinating. And I'm sure all of us have, to a degree, read about certain founders. There's an entrepreneurial spirit, obviously, to get it off the ground, to get an idea, to go from an idea into actually action. I guess, what are some of the details within that process of a founder, obviously bringing a company ultimately to market, that might stick with people or might, just people can relate to on some level?
Yeah, it's funny. It's a great question. I think founders are definitely unique individuals. To your point, when you think about what it takes to scale a company to the point of making it to the public markets, it takes a visionary. It takes someone willing to take risks, to be bold in their vision, to employ the right talent around them and empower the talent around them. So if I had to leave investors with a few attributes, I would mention the following. I would say first and foremost, they're innovative. They bring some new idea, new service to the market that makes people's lives better. I mean, it's as simple as that. They see a way to provide something to the end customer that they're not receiving. They usually do it at a cheaper cost. So there's value in terms of the economic value, but there's usually value in terms of time saved, in terms of the utility it brings to the end customer. So I'd say innovative, and I'd say customer obsessed. If you think about the most successful companies, a lot of them that were originally founder led, they usually start with the end customer's experience first and work their way backwards to monetization. That's why a lot of these companies often, in the public's eyes, screen very expensive. They're growing at a fast rate. It's hard to value them on near-term earnings and free cash flow, but they have a long path to monetization, because that's kind of the end goal. The first goal is to make customers really happy and love your product. So I'd say those two, and last but not least, I have to throw in an important one, which is they're fully committed. They are large investors and owners of the business. So they own a big chunk of the company, and so that makes their interests very aligned with us as shareholders. So we're both looking through all the noise in the short term and really want to focus on maximizing value over the next 3, 5, 10 years.
I wonder if everyone can think of, an entrepreneur in their own life, whether it's, someone within their family or someone that they knew from school trying to start something up. How did this sort of interest you on some level? I mean, because it's not for everyone, actually.
Yeah, I appreciate the question. Actually, a little story that probably dovetails with both my passion for investing and how I became, a portfolio manager, and my belief that founders and founding families are unique individuals, was probably my first job in high school. I was a grocery clerk. So I stocked shelves, and it was at a family-run business, so founder-led, but it jumped a generation to the next the next generation. And what was so unique on the family and founder-led side was just how every employee at that organization, even myself as a part-time employee, really felt like a member of the family. I would hear stories about people that joined the company right, at 18, didn't go to college, and by the time they were 50, they were millionaires. And you might say, okay, as a grocery store employee, this company was really committed and believed that each employee should have some ownership in the business. And so they had profit sharing, and the company grew, and everyone's incentives were aligned. The customer service was off the charts because I think all the employees felt very empowered and felt like they were one of the family. And so I think that experience really made an impression on me. And then on the investing side, I was one of those annoying kids, Pamela, where I would ask so many questions. I had a real passion for learning. I wondered why certain companies would have a certain amount of shelf space, or why certain products were on sale to drive incremental volume. And really, it started then with me kind of thinking about, okay, how are some companies more successful than others? How is that kind of translating into profitability? And unfortunately, I never had much money in high school and college, but I did start kind of mock portfolios then, and started to think about investing more seriously throughout high school.
I mean, you're kind of rooting for the people who are starting these companies and their family led, because as you say, it's sort of, they're taking so much of it on themselves in some ways. And Dan, I'm sure that, when your kids ask questions, millions of questions, you answer all of them perfectly now. So it's all coming back to roost.
It is. I'm getting paid back.
Paid back on some level. Okay, so let's go through to sort of what the fund, is starting to look like. Some of the positioning, some of the construction, some of the pieces within that. Maybe it fits with the evolution to an extent of sort of where it began, how you look at it now. Is there something that has evolved, or is it still, how would you say it's focused at this point?
Yeah, I would say first and foremost, let me just give you a little snippet on me as an investor. I tend to be what's called a growth at a reasonable price investor. So I'm trying to find long duration, growth rates that I think are on sale today in the current marketplace. So why is that a good fit for a fund like this? I am finding a lot of founder-led companies that I think can grow at a very high rate for a long period of time. And I think the market in many cases is underappreciating the durability of those growth rates. And so when you think about the evolution of this fund, because of the universe tends to be very new economy. What do I mean by that? I mean, obviously the founders involved in some capacity in these companies and adding a lot of value. That means the founder's still alive. That means they've probably only been around for, 3 decades at the most in many cases. And so as a result of that, it tends to have a lot of technology companies, a lot of healthcare companies, a lot of consumer companies. So it has this growth tilt over a long period of time. I'm trying to find companies that I think can be the next large caps, mega caps. Think of, the common household names today like Amazon, Facebook. I would love to find them when they're little seedlings. They haven't become trees yet, but and so this fund was a really good fit, I think, for both the way my investment philosophy, the way I manage money, and then the universe itself really dovetailed well with that investment philosophy. So then fast forward to the pandemic. This fund was pretty well positioned to benefit from the environment we've been in for the past, 14, 15 months. And why is that? I mean, if you think about the technology and the healthcare and the consumer companies, a lot of these companies are very digital forward. They're growing, they're doing something very, very different that is resonating with the end customer. As I mentioned about founders being incredibly committed in owning a fair amount of the company, they tend to have strong capital structures. They tend to have a lot of cash on the balance sheet, be well financed. And so if you combine the fact that they didn't need the capital markets when we went into the swoon of March of 2020, when there was a lot of uncertainty, with the fact that they had something that tended to resonate with the end customer that would likely grow through a pandemic. In some cases, the digital or companies levered to digitalization got a turbo boost. So their stocks were going down, but their business prospects were improving. I continued to add to those names during the initial swoon, and that helped tremendously during the first 6, 7, 8 months of the pandemic. Fast forward to today, and this fund was fortunate, and we did a relatively nice pivot around the vaccine data, the election results, in terms of embracing cyclicality. It is a little challenging in a fund like this to get tremendously cyclical because of what I just described, with new economy being kind of the backbone of this company, of this fund. And when you think about old economy companies, which are been around for 100 years, in many cases, the founder has long since passed away. It's tough to really have that same culture and all those attributes I described earlier. So that being said, I have found some names across a lot of end markets, materials, financials, even I would say even energy, that are founder led. They're differentiating themselves. They screen really attractive on my framework of that duration of growth. So I think we're a little bit more barbell than we've been in the past right now, which is nice because I think there's some growth names on sale and there are some more cyclical names on sale.
It must be a really interesting time in the markets to go hunting for some of these opportunities. Can you just bring us up to date on sort of what they call the universe of companies? So you will screen companies down to sort of X number that you can look at. Are they all in North America? Do they tend to be in a universe that's global? How does that work?
Yeah, so I am predominantly founced on North America, and that universe is about 700 plus companies. So there's a big sandbox, even though you think founder-led companies are few and far between as they age and the founders ultimately remove themselves from the companies. There's a big sandbox to play in here. And I think the reason why, I should be clear in terms of how I define founders. So I define founder-led companies as the founder having tremendous influence on the company. And so what I mean by that is they can be the traditional CEO, which is more than not the case. That being said, some founders are having tremendous influence on the board. Sometimes they're like a chief creative officer. If you think of some like apparel companies or retail-oriented companies, the founder, the person on the label tends to be more of the creative element, but maybe not the best at managing people, but they can still add a tremendous amount. So that's how I define the universe, or they own a tremendous amount of stock, so they can have a lot of through their ownership. And then in terms of opportunity outside the US, Pamela, there's multiples of that 700, almost 3 times as many companies outside the US that meet my liquidity thresholds and that definition of founder-led. So again, a lot of companies, a lot of rocks to turn over out there. And I think we're about 12% outside the US right now. And that could grow over time as we find more opportunity.
It's a really exciting area. Most disciplines, most approaches will need a discipline. You have your discipline. Financial advisors obviously help to instill that in investors. I mean, maybe it's an obvious question, but I wonder if you can just sort of go over how you maintain your discipline as markets change, which they do, obviously.
Yeah, so it's a great question. I have a very quantitative approach. So I keep a detailed spreadsheet where I assess risk reward on a multi-year view across every stock I own in the fund, and then every stock I've ever monitored, if you will. So there's over 1,000 companies in that spreadsheet. It's an iterative spreadsheet. You don't want to be too focused on what you think a stock is worth, because these are names I want to own for years and years and years. And oftentimes the stocks will have a nice run, and then they'll stabilize and grow into their valuation, and then they'll have another run, and so it's a little bit more art than science. But I think the last year was really interesting in that we got almost like a full economic cycle in a really truncated period of time, and so that led to potentially a little bit more turnover than you would have. This fund's not a high turnover fund, but names that that were really expensive just got the valuation spread got way too wide versus some of those more cyclical names that got really cheap. And so I let the market tell me where the greatest mispricings are, and so I rotated some of that capital into the founder-led companies that I thought looked really mispriced on a multi-year view. And I continue to be excited about kind of both sides of the barbell right now.
So this is not an easy question, and people all over the place are debating this and spending 24 hours of breathing time debating this. But why is inflation important to the way you invest, and why do we care, and how do you invest around it or towards it? I mean, how is it useful and not useful?
Yeah, it's a good question. I tend to be a micro, stock focused first investor versus kind of macro top level investor. But I think in the environment the pandemic has kind of forced us to be in, you have to pay attention to kind of the macro more than you have had in the past. And that's because the Fed, the US Fed responded with tremendous stimulus. So there's a lot of liquidity in the system. The Fed's balance sheet has grown tremendously. The US government provided a lot of fiscal stimulus in terms of mailing checks to US consumers. And so there's a lot of money sloshing around out there. And the reason why inflation is important is because as I think about the duration of a company's revenues, earnings, and free cash flow, I have to underwrite some sort of economic environment. And I think the key thing people are focused on right now is some of the stimulus-driven growth versus kind of structural growth that we'll be able to compound ourselves off of coming out of this. And what's really important to figuring out the answer to that question is how long will the Fed provide such a stimulative environment? And inflation expectations are a component of risk taking, a component of what you think nominal growth will be. And we've had negative real interest rates, which means, if you take the risk-free rate less inflation expectations, we've been in a negative scenario, which encourages a lot of risk taking. So if by chance inflation expectations come down or rates really increase, it's obviously a less stimulative environment, which can impact companies' cost of capital. So that's a long-winded way of saying inflation is a key component of nominal economic growth. And if by chance it really heats up, the Fed will look to curtail inflation and likely raise rates and potentially curtail the economic cycle.
And we've certainly seen some of that through the market action the last couple of days. And, maybe you can comment on that. But actually, I really love you to just spend some time breaking down the sectors that you're interested in. I mean, within consumer, for instance, maybe we will go back to malls. Maybe we won't. Maybe we'll just stick with online. I mean, how do you look at the consumer areas at this point? What's of interest, for instance, and then other sectors we'll talk about too.
Yeah, it actually fits well relative to the economic discussion before. I have embraced some of those more cyclical sectors. So within consumer, for example, I've trimmed some of the higher beta names that benefit from a lot of money sloshing around. If you think gaming companies, for example, I still have a decent exposure to housing. U.S. housing is seeing tremendous price appreciation. There's limited supply. It's having a big wealth effect, and the stocks are cheap. but I've shifted a little bit more to like higher quality names from the higher beta names. So I think of some retailers that are in the fund. They're kind of more apparel focused. They have great balance sheets, high returns on invested capital. They did a great job kind of transitioning the consumer to more of a digital first consumer, which allows them to manage their real estate footprint better, more efficiently, their cost structure more efficiently. But on your malls question, I've even embraced some real estate companies. I think those are hard assets. We are in an environment which, inflation expectations have risen despite the last week or two's contra to that. Over a longer period, inflation expectations are up, and I think that's healthy. I think that ultimately could accrue to asset values, and I think people will start to behave more like the old normal than some sort of kind of dramatic new normal. So I have embraced some real estate companies, and energy would be kind of an interesting sector where I've increased exposure to, because when you think about it, we had, technically we had negative oil prices last spring. And that was obviously, we can talk about that another time. That was more of a arbitrage driven thing, but it's such a capital intensive industry, and we have such a focus on carbon emissions and ESG right now, that companies were under incented to invest in building more energy infrastructure at very low prices, and they're still kind of under incentivized to commit capital to new projects despite the oil price coming up. So I think we could potentially see a tighter environment for oil prices for longer. And then if you add in regulation, where we're trying to accelerate this move to renewables, and I mean, if we go trying to build, hundreds of billions of dollars of renewable capacity, that's very carbon intensive. It really will impact oil demand, along with other economies coming out of this pandemic, which increases oil demand. So it feels like we could have a little bit of a tighter environment there. And there's a few companies that are in this fund that are, I would say, pioneering on the ESG side, even though they're obviously carbon companies, but they're committed to making a difference on the ESG side. And they screen really attractive at oil prices $15 a barrel ago. And obviously we're much higher. So again, this speaks to some of the evolution of the fund, but there are a lot of exciting growth companies too. So I don't want to belabor the cyclical side. It just shows you this is a great stock pickers environment, and I couldn't be more excited at the ideas I'm finding that are represented in this fund.
Dan, over the last year and a bit, I guess, after we sort of came out of that major trough, there really been no shortage of IPOs, for instance. Now that said, those go through, in a way, their own trajectory, and they evolve. We're using this word a lot, but in their own ways. What is your outlook for kind of new founders on the horizon, ultimately going the route of IPOs? What does it look like out there?
That's the beauty of working at a place like Fidelity. We have so many resources. We have so much access to private companies and public companies. I continue to meet with private companies regularly. I'm trying to find emerging technologies and products, in addition to finding the next best companies. And oftentimes talking to private companies can be a tremendous source for doing that. So I think, despite the fact that it's been a little bit of a bumpier road for IPOs from a market cycle standpoint in the last month or two, I'm still finding a lot of new founder-led companies that are on my radar. I might not necessarily want to own them right out of the gates. They're not the right price sometimes, but they're companies that I think could be really special with a multi-year view. And so I get to know them better. I get to know the founders. Not every founder is this unique individual that I've described. So I think it's really important to not just meet him or her once or twice. It's oftentimes meeting them, meeting levels of management below them, and it's really a long due diligence process. So I'm still finding a lot of interesting founder-led companies out there, and I think they actually come to us more when the IPO capital market cycle gets a little shaky, because they want more input from folks like us, so that they can ultimately achieve all of their goals.
Absolutely fascinating. So this must be such an interesting time right now, as as you have some of those conversations. Maybe less of them will be over Zoom and more of them will
Yes,
be in person. I mean,
hopefully.
wouldn't that be nice too?
Be great.
A lot of people joining us here today are unit holders. I just kind of a final message or wrap up message that you might have for those joining us, Dan.
Yeah, I would just like to thank all the unit holders for really entrusting me with their capital, their hard-earned capital. I'm, leveraging all the resources Fidelity has, and I'm working hard with the team here to find, hopefully a lot of great ideas that will add value over time. So thank you. Thanks for the time today, and thanks for having me.
That's great. Dan Kelley, thank you very much for joining us here on The Upside. And thank you to everyone else who's joining us for this great conversation. We know it's been kind of fabulous to have you, intimately join this conversation with Dan, and we get some ideas moving around. We have a fantastic lineup of shows on the way on The Upside as well. So please head to fidelity.ca for more information on that. There's also replays of The Upside. You can find those on YouTube as well. So thanks for joining. We'll see you again next time. I'm Pamela Ritchie.
Hi, my name is Jessie Serafian, event manager here at Fidelity and certified yoga instructor. And I'm pleased to be the new co-host of our investor webcast series, The Upside. We're expanding The Upside to also focus on health and wellness. With personal wellness and finances coming together, this ties into your overall health and wealth. Stay tuned for new wellness-focused webcasts coming soon. Here is your Fidelity Wellness Tip, an opportunity to invest in your health. So notice how you're sitting. Make sure both feet are flat on the floor, sit up nice and tall, roll your shoulder blades down your back, and rest your hands gently on your thighs. Closing the eyes or soften the gaze. And start to bring your attention to your breath. Taking deep inhales and exhales in and out through the nose. And as you sit here, notice any areas of the body where you're holding tension or gripping, and bring more breath into that space. From here, gently opening the eyes, take an inhale in through the nose, and then exhale, you're going to turn your head towards the right, bringing your chin towards your shoulder. And then inhale back to center. And then exhale, turning your head to the left. Chin to your shoulder. Inhaling back to center. As you exhale, bring your right ear now to your right shoulder. Feeling that stretch into the left side of your neck. Inhaling back up. And then exhale, left ear to left shoulder. Continuing to breathe in and out through the nose. Inhaling back up. And then exhale, tuck your chin into your chest, stretching the back of the neck. And then slowly lifting your head up, coming back to center. Hope this helps. Thanks for watching.